Welcome to Corporate Snooze, slow stories of business innovation, corporate history, and other related subjects, chosen specifically for their sleep-inducing qualities. So relax, unwind gently, and let the subject matter do the rest. In this video, we explore the history of insurance. Let's begin. In the earliest human societies, long before there were formal institutions or written contracts or any organized systems of law, people faced risks and uncertainties that could disrupt their lives. A harvest might fail, a storm might destroy a dwelling, an illness might strike, a journey might end in misfortune. These risks were managed, if they were managed at all, through informal arrangements, through family and community support, through shared resources and mutual obligations that were based on custom and on the understanding that those who helped others in times of need could expect help in return when they themselves faced difficulties. This was not insurance in the sense that would later develop, but it contained elements that would eventually be formalized into insurance systems. The idea of spreading risk, of pooling resources, of providing support when specific adverse events occurred. As societies became more complex, as trade expanded, as people began to travel greater distances and to engage in activities that involved larger risks, the informal arrangements proved insufficient. Merchants who sent goods by ship faced the possibility that the ship would sink, that the cargo would be lost, that storms or pirates or accidents would destroy their investment. The loss of a single shipment could ruin a merchant, could wipe out wealth that had been accumulated over years. There was a need for mechanisms that could spread this risk, that could allow merchants to continue trading even when individual voyages failed. And it was in the context of maritime trade that some of the earliest forms of insurance began to emerge. In the ancient world, there were practices that resembled insurance, though they were not called by that name and did not have the formal structures that would later develop. Merchants in ancient Mesopotamia, in Greece, in Rome, engaged in arrangements where the risk of loss at sea was shared among multiple parties. One form of such arrangement was the bottomry loan, where a merchant borrowed money to finance a voyage, using the ship itself as collateral, and if the ship was lost at sea, the loan did not have to be repaid. The lender was taking on the risk of the voyage in exchange for a higher rate of interest than would be charged for a normal loan. This was not precisely insurance, as it was structured as a loan, but it had the effect of transferring risk from the merchant to the lender, allowing the merchant to undertake the voyage without bearing the full risk of loss. In medieval Europe, as trade revived and expanded, particularly in the Mediterranean, similar practices developed. Italian merchants in cities such as Genoa and Venice engaged in maritime commerce on a large scale, and they developed more formalized contracts for sharing risk. These contracts specified that if a ship and its cargo were lost, the loss would be borne not by the merchant alone, but would be shared among a group of investors who had agreed to participate in the venture. The contracts were written. They specified the terms, the parties involved, the risks covered, and they were enforceable through the legal systems that were developing in these commercial cities. This was a step toward insurance, as it involved explicit agreements to cover specific risks in exchange for payment, though it was still closely tied to particular voyages and particular cargoes, rather than being a separate financial transaction. The word insurance itself, or its variants in different languages, began to appear in documents in the 14th century. The term came from the idea of insuring, of providing assurance against loss, and it referred to contracts where one party, the insurer, agreed to compensate another party, the insured, if a specified loss occurred, in exchange for a payment, a premium, made by the insured to the insurer. The development of insurance as a distinct practice, separate from loans or from simple partnerships, was gradual, and it occurred in the context of the legal and commercial institutions of late medieval and early modern Europe. Marine insurance became more standardized and more widely used in the 15th and 16th centuries. Insurance policies were written by merchants and by specialized brokers, individuals who facilitated the arrangement of insurance by bringing together those who sought coverage and those who were willing to provide it. The policies specified the ship, the voyage, the cargo, the risks covered, which typically included perils of the sea, such as storms, shipwrecks, and piracy, and the amount that would be paid if the loss occurred. The premium was negotiated based on the perceived riskiness of the voyage, on the reputation of the ship and its captain, on the route, on the season, on the nature of the cargo. There was no systematic calculation of risk, no statistical analysis, but there was accumulated experience, informal knowledge about which voyages were more or less dangerous, and premiums reflected this knowledge, though in a rough and approximate way. The practice of insurance spread beyond the Mediterranean. In London, by the 17th century, marine insurance was common, and it was conducted in informal settings, often in coffee houses where merchants and ship owners and insurers gathered to exchange information, to negotiate policies, to conduct business. One such coffee house, opened by Edward Lloyd in the late 17th century, became a central location for marine insurance, and it would eventually give its name to Lloyd's of London, one of the most important insurance institutions in the world. Lloyd's Coffee House provided a place where underwriters, individuals who agreed to insure ships and cargoes, could meet with those seeking insurance, where information about ships and voyages could be shared, where the terms of policies could be discussed and agreed upon. The Great Fire of London, which occurred in 1666, was a catastrophic event that destroyed much of the city, burning for several days and leaving tens of thousands of people homeless. The fire demonstrated the risks associated with urban living, with densely packed wooden buildings, with limited means of fighting fires, and it created an awareness of the need for some mechanism to protect property owners from the financial consequences of such disasters. In the aftermath of the fire, there was discussion of how to prevent future fires and how to mitigate the losses when fires did occur, and this led to the development of fire insurance. Fire insurance began to be offered in London in the late 17th century. The first fire insurance companies were established, organizations that sold policies to property owners, promising to pay for the cost of rebuilding if the property was destroyed by fire. The policies specified the property, the amount of coverage, the premium to be paid, and the conditions under which the insurance would pay out. The companies employed surveyors who assessed properties, who estimated the value and the risk, and who determined what premium should be charged. The companies also employed firefighting brigades, teams of men who would respond to fires and attempt to extinguish them, though their primary concern was protecting the properties that were insured by their company, rather than fighting fires in general. The development of fire insurance required new ways of thinking about risk, about how to assess the likelihood of fire, about how much to charge for coverage, about how to ensure that the company collected enough in premiums to be able to pay claims when fires occurred. This was not straightforward, as fires were relatively rare events for any individual property, but when they did occur, the losses could be substantial. The insurance companies needed to have reserves to hold funds that could be used to pay claims, and they needed to set premiums at levels that would allow them to build these reserves while also covering their operating expenses and providing returns to their investors. The concept of probability, the mathematical study of uncertain events, began to develop in the 17th century, and it would eventually provide the foundations for actuarial science, the discipline that applies mathematical and statistical methods to assess risk and to calculate premiums in insurance. Early work on probability was done by mathematicians such as Blaise Pascal and Pierre de Fermat, who analyzed problems related to games of chance, to dice and cards, and who developed principles for calculating the likelihood of different outcomes. These principles were abstract and theoretical, and their immediate application to insurance was limited, but they represented a new way of thinking about uncertainty, about how to reason about events whose outcomes were not known in advance, but could be described in terms of probabilities. The application of probability to insurance required data, information about how often particular events occurred, about the distribution of losses, about the factors that influenced risk. For life insurance, which began to develop in the 17th and 18th centuries, the key data were mortality rates, information about how long people lived, about how the risk of death varied with age, with health, with occupation, with other characteristics. The earliest life insurance policies were often short-term, covering a specific period, such as a voyage or a year, and they were priced based on informal judgments rather than on systematic analysis. The development of mortality tables, systematic records of death rates at different ages, was an important step toward more scientific life insurance. In the late 17th century, Edmund Halley, an English astronomer and mathematician, analyzed mortality data from the city of Breslau in Silesia and constructed a life table that showed the probability of death at each age. Halley's table was one of the first attempts to use empirical data to estimate mortality rates, and it demonstrated that it was possible to calculate, at least approximately, the likelihood that a person of a given age would survive for a certain period. This information could be used to set premiums for life insurance, to determine how much should be charged for a policy that would pay a specified sum if the insured person died within the policy period. The use of mortality tables and of probabilistic reasoning was not immediately adopted by all insurance providers. Many continued to rely on informal methods, on experience and on judgment, and there was skepticism about whether mathematical calculations could capture the complexities of human mortality, the variations among individuals, the uncertainties about the future. However, over time, as more data became available, as the methods were refined, as the advantages of systematic calculation became apparent, the actuarial approach gained acceptance, and it became standard practice in life insurance by the 19th century. Actuaries, professionals trained in mathematics and statistics, and in the analysis of risk, emerged as a distinct occupation. They worked for insurance companies, calculating premiums, assessing risks, ensuring that the company's reserves were adequate to meet future claims, analyzing the financial stability of the company's portfolio of policies. The work of actuaries was technical and detailed, involving the manipulation of tables, the application of formulas, the projection of future cash flows, the assessment of the assumptions underlying the calculations. It was also consequential, as errors in actuarial calculations could lead to premiums that were too low, leaving the company unable to pay claims, or too high, making the policies uncompetitive and driving customers to other providers. The development of actuarial science was closely tied to the development of life insurance, but the principles could be applied to other types of insurance as well. Fire insurance, marine insurance, insurance against accidents, against theft, against various other perils. All of these could benefit from systematic analysis of data, from the application of probability, from the calculation of appropriate premiums based on estimated risks. The challenge was to collect relevant data, to identify the factors that influenced risk, to build models that captured the essential patterns, and to update these models as new information became available. Lloyd's of London, which had begun as an informal meeting place in a coffee house, evolved into a more structured institution over the 18th and 19th centuries. The underwriters at Lloyd's, individuals or small groups who provided insurance, formed syndicates, pooling their resources and their risks. Each syndicate was managed by an underwriter who made decisions about which risks to accept, at what premiums, and who bore responsibility for the financial performance of the syndicate. The syndicates competed with one another, but they also cooperated, sharing information, developing common practices, and operating within a framework of rules and customs that governed the Lloyd's market. The Lloyd's model was distinctive in that it was not a company, but a market, a place where insurance could be arranged, where risks could be underwritten by individuals or by small partnerships, rather than by large corporations. This structure allowed for flexibility, for specialization, for the willingness to insure unusual or complex risks that larger, more bureaucratic organizations might not be willing or able to handle. Lloyd's became known for insuring ships and cargoes, but it also insured other things, buildings, artworks, even individuals against specific risks, and it developed a reputation for being willing to consider almost any proposal, for being creative and adaptable in finding ways to provide coverage. Reinsurance, the practice of insurers purchasing insurance themselves to protect against large losses, developed as insurance became more widespread and as the scale of potential losses grew. An insurance company that had issued many policies faced the risk that a catastrophic event, a major fire, a hurricane, an earthquake, a large maritime disaster, could result in claims that exceeded the company's reserves, that could threaten its solvency. Reinsurance allowed the company to transfer some of this risk to another insurer, the reinsurer, who would agree to cover a portion of the losses in exchange for a portion of the premiums. Reinsurance helped to stabilize the insurance industry, to allow companies to take on risks that they could not prudently bear alone, and to spread risks more widely across the industry and across different geographic regions. The 19th century saw the expansion of insurance into many areas of life. Life insurance became more common, with policies sold not only to wealthy individuals, but to middle-class families, to workers, to people seeking to provide financial security for their dependents. Mutual insurance companies were formed, organizations owned by the policyholders themselves rather than by outside investors, and these mutual companies operated on the principle of sharing risks and benefits among members. Savings banks and friendly societies offered insurance-like benefits, combining savings with coverage for sickness, for burial expenses, for other needs. Industrial insurance, also called home service insurance or debit insurance, was developed to serve working-class families who could afford only very small premiums. Agents would visit homes weekly to collect premiums, often just a few pennies, and the policies provided modest death benefits, enough to cover funeral expenses and to provide some small support to the family. This form of insurance required a large network of agents, a system for tracking payments and policies, and it was labor-intensive and had high administrative costs relative to the premiums collected, but it made insurance accessible to people who would not otherwise have had any coverage. Accident insurance emerged in the 19th century, covering injuries from railway accidents, from industrial accidents, from various mishaps. The growth of railways, of factories, of machinery brought new risks, and there was demand for protection against the financial consequences of injury, of disability, of death resulting from accidents. Insurance companies developed policies that covered medical expenses, that provided income replacement if the insured person was unable to work, that paid benefits to families if the insured person died. Liability insurance, covering the insured person's legal responsibility for harm caused to others, also developed during this period. As legal systems increasingly held individuals and businesses liable for injuries or damages they caused, there was a need for insurance that would protect against the financial consequences of such liability. Employers' liability insurance covered businesses against claims from workers injured on the job. Public liability insurance covered businesses and individuals against claims from customers or members of the public. Professional liability insurance, also called malpractice insurance, covered professionals such as doctors and lawyers against claims arising from errors or negligence in their work. The insurance industry became more organized and more regulated over the 19th and early 20th centuries. Governments enacted laws governing the formation and operation of insurance companies, requiring companies to hold adequate reserves, to be licensed, to submit to oversight, to protect policyholders from fraud and from insolvency. Insurance regulators were established to enforce these laws, to monitor the financial condition of companies, to review policy forms and rates. The regulation was motivated by concerns about the vulnerability of policyholders, who often had limited information and limited ability to assess the financial strength of insurance companies, and who depended on companies to honor their promises years or even decades in the future. The 20th century brought further expansion and diversification of insurance. Automobile insurance became necessary and widespread, with the proliferation of cars, covering damage to vehicles, injuries to people, liability for accidents. Health insurance, which covered medical expenses, grew in importance as medical care became more expensive and as more people sought protection against the financial burdens of illness and injury. Property insurance covered homes and their contents against fire, theft, and other perils. Crop insurance protected farmers against losses from weather, pests, disease. The two world wars of the 20th century had significant effects on the insurance industry. War risks, the possibility that property would be destroyed, or that people would be killed or injured as a direct result of military action, were generally excluded from standard insurance policies, but governments sometimes provided war risk insurance or compensation schemes. The wars also disrupted international insurance markets, interrupted the flow of premiums and claims, and led to the failure of some insurance companies. After the wars, the industry rebuilt, and new forms of insurance were developed to address the risks of the modern world. Reinsurance became more sophisticated and more global, with large reinsurance companies operating across borders, providing capacity to insurers in many countries, developing expertise in assessing and pricing large and complex risks. The reinsurance market helped to manage the concentration of risk, to prevent the failure of individual insurers from cascading through the system, and to allow the insurance of risks that were too large for any single company to bear. Reinsurance treaties, agreements where a reinsurer agreed to cover a specified portion of an insurer's portfolio on an ongoing basis, provided stability and predictability. Facultative reinsurance, where specific large risks were reinsured individually, allowed for tailored coverage of unusual exposures. The development of computers and of data processing in the latter half of the 20th century transformed the insurance industry. Insurers could now store and analyze large amounts of data, could develop more sophisticated models of risk, could process policies and claims more efficiently. Actuaries used computers to run complex calculations, to simulate outcomes, to test the sensitivity of their models to different assumptions. Underwriters used data to assess risks more accurately, to identify patterns, to price policies more precisely. Claims adjusters used databases to track claims, to detect fraud, to expedite settlements. Risk modeling became a specialized field within insurance and reinsurance. Modelers built detailed simulations of natural catastrophes, hurricanes, earthquakes, floods, estimating the potential losses from events of different magnitudes, identifying the geographic distribution of risk, helping insurers and reinsurers to understand their exposures and to set prices and reserves appropriately. The models used historical data, scientific understanding of natural phenomena, information about the characteristics of buildings and infrastructure, and they produced estimates of the frequency and severity of losses. The models were imperfect, as they depended on assumptions and on data that might not fully capture future conditions, but they represented a significant advance over the informal methods that had been used previously. The insurance industry also expanded internationally, with companies operating in multiple countries, offering coverage across borders, competing in global markets. International insurance and reinsurance became major industries, involving large flows of premiums and claims, complex legal and regulatory issues, and coordination among insurers, reinsurers, brokers, and regulators in different jurisdictions. The diversity of legal systems, of regulations, of market conditions created challenges, but it also created opportunities for specialization, for the development of expertise in particular types of risks or particular markets. Insurance penetrated deeply into modern life, becoming a routine part of household finances, of business operations, of public policy. Most people in developed countries had some form of insurance, covering their homes, their cars, their health, their lives. Businesses purchased insurance to protect their assets, to cover their liabilities, to manage their risks. Governments required certain types of insurance, such as automobile liability insurance, workers' compensation insurance, and governments themselves often acted as insurers, providing social insurance programs for retirement, for unemployment, for healthcare, for disability. The concept of moral hazard, the idea that insurance might change behavior, might lead people to take greater risks because they were protected from the consequences, was recognized and studied. Insurers developed mechanisms to limit moral hazard, such as deductibles, where the insured bore the first portion of any loss, and coinsurance, where the insured bore a percentage of the loss, and policy exclusions, where certain types of behavior or certain types of losses were not covered. These mechanisms sought to align the incentives of the insured with the goals of risk reduction, to prevent insurance from encouraging recklessness or negligence. Adverse selection, the tendency for those at higher risk to seek insurance more than those at lower risk, was another concern. If insurers could not distinguish between high-risk and low-risk individuals, they might charge a single premium based on the average risk. But this would make insurance expensive for low-risk individuals, who might choose not to purchase it, leaving the insurer with a pool of mostly high-risk individuals, which would drive up costs and premiums further. Insurers sought to address adverse selection through underwriting, through asking questions and collecting information to assess individual risk, through medical examinations for life and health insurance, through inspections for property insurance, through driving records for automobile insurance. The use of detailed information and of statistical models helped insurers to price policies more accurately, but it also raised concerns about fairness, about discrimination, about privacy, about the use of genetic information or other sensitive data. The regulation of insurance evolved to address these concerns, to protect consumers, to ensure fairness, to promote stability. Laws prohibited discrimination on certain grounds, required disclosure of policy terms, mandated that companies maintain solvency, established processes for handling complaints and disputes, and created guarantee funds to protect policyholders if an insurance company failed. The balance between allowing insurers to assess risk and price accordingly and protecting individuals from unfair treatment was delicate and was the subject of ongoing debate and adjustment. Insurance fraud, both by policyholders making false claims and by insurance companies engaging in deceptive practices, was a persistent problem. Insurers invested in fraud detection, in investigating suspicious claims, in using data analytics to identify patterns that might indicate fraud. Legal systems provided remedies for fraud, allowing insurers to deny claims and to pursue criminal charges in cases of deliberate deception. However, the line between fraud and legitimate disagreement about the interpretation of policy terms or about the extent of loss was sometimes unclear, and disputes were common. Microinsurance, insurance designed for low-income individuals in developing countries, with low premiums, simple terms, and coverage for basic risks, emerged as a field in the late 20th and early 21st centuries. Microinsurance aimed to extend the benefits of insurance to populations that had not previously had access, to provide protection against health expenses, against crop failures, against the death of a breadwinner, and to contribute to poverty reduction and to economic development. The delivery of microinsurance required innovations in distribution, in product design, in the use of mobile technology, in partnerships with local organizations, in ways to keep administrative costs low enough that small policies could be economically viable. Parametric insurance, where payouts were triggered by the occurrence of a specified event rather than by the assessment of actual losses, was developed for certain types of risks, particularly natural catastrophes. In parametric insurance, if an earthquake of a certain magnitude occurred, or if rainfall fell below a certain level, or if wind speeds exceeded a certain threshold, the policy would pay a predetermined amount, without requiring a detailed assessment of damages. This simplified claims processing, reduced disputes, provided quick payouts, and was useful in situations where assessing individual losses was difficult or expensive. Insurance-linked securities, financial instruments that transferred insurance risk to capital markets, allowed insurers and reinsurers to access capacity beyond the traditional reinsurance market. Catastrophe bonds, for example, were bonds where investors received interest payments. But if a specified catastrophic event occurred, the investors would lose part or all of their principal, and those funds would be used to pay insurance claims. This connected insurance risk with capital markets, creating new sources of capacity, diversifying risk, and allowing investors to gain exposure to risks that were largely uncorrelated with traditional financial market risks. The history of insurance, from its informal beginnings in ancient trade, through the development of marine insurance in medieval and early modern Europe, through the emergence of fire insurance after the Great Fire of London, through the gradual development of actuarial science and of systematic risk assessment, through the expansion of insurance into all areas of modern life, through the increasing use of data and technology, through the globalization and the sophistication of modern insurance and reinsurance markets. This history was a history of human responses to uncertainty, to the risks and perils that were inherent in life, in economic activity, in the operation of complex societies. Insurance did not eliminate risk, but it redistributed it. It pooled it. It allowed individuals and organizations to transfer risks to those who were willing and able to bear them in exchange for payment. The mechanisms were technical, involving probability, statistics, law, finance, but the purpose was fundamentally human: to provide security, to reduce anxiety, to allow people to plan and to invest and to live without the constant fear that a single adverse event would destroy everything they had built. The development of insurance as an institution involved not only technical and financial mechanisms, but also social and cultural changes in how people thought about the future, about risk, about responsibility. In societies where fate and divine will were seen as the primary determinants of events, where misfortune was understood as punishment or as random acts of the gods, the idea of systematically protecting against loss through financial arrangements might have seemed presumptuous or impious. The shift toward seeing risks as quantifiable, as events that could be analyzed and managed through human effort, was a gradual one, and it was intertwined with broader changes in worldview, with the development of science, with the growth of commerce, with the rise of individualism, and of notions of personal responsibility. The language of insurance reflected its origins and its evolution. Terms such as premium, policy, underwriter, claim, coverage, exclusion, deductible. These became part of common vocabulary, understood by millions of people who purchased insurance and who interacted with insurance companies. The insurance policy itself, the written document that specified the terms of the agreement between insurer and insured, evolved from simple handwritten notes to lengthy printed documents with standard clauses, definitions, conditions, exclusions, endorsements. The complexity of these documents was often a source of frustration for policyholders who found them difficult to read and to understand, filled with legal language and with provisions that seemed designed to limit the insurer's obligations rather than to clarify them. The interpretation of insurance policies, the determination of what was covered and what was not, became a matter for courts and for legal systems. Insurance law developed as a specialized area of law, with doctrines and precedents that governed how ambiguities were resolved, how disputes between insurers and insured were adjudicated, what duties and obligations each party had. The principle of utmost good faith, the idea that both parties to an insurance contract should act honestly and should disclose all relevant information, was fundamental to insurance law, though its application in practice was sometimes contested, particularly when insurers sought to void policies based on alleged failures by the insured to disclose information that the insurer considered material. The role of insurance brokers, intermediaries who helped individuals and businesses to find appropriate insurance coverage, grew in importance as insurance became more complex. Brokers represented the interests of the insured rather than the insurer, though they were typically compensated by commissions from the insurers whose policies they sold, creating a potential conflict of interest. Brokers provided advice, compared policies, negotiated terms, assisted with claims, and for large commercial risks, they often had specialized knowledge and relationships with insurers and reinsurers around the world. The professionalization of insurance broking, the establishment of standards and certifications, the regulation of broker conduct, these were part of the ongoing effort to ensure that the insurance market functioned fairly and efficiently. Insurance companies themselves varied greatly in size, in structure, in the markets they served. Some were large publicly traded corporations with thousands of employees, diversified portfolios of risks, global operations, and shareholders expecting profits and dividends. Others were mutual companies, owned by their policyholders, operating on a cooperative basis, with surpluses returned to policyholders as dividends or used to reduce premiums or to strengthen reserves. Still others were small regional or specialty insurers, focusing on particular types of risks or particular geographic areas, often with more personal relationships with their clients and with more flexible underwriting. The culture within insurance companies, the values and practices that guided employees, was shaped by the nature of the business. Insurance involved long time horizons, with policies sold today generating claims that might not be paid for years or even decades. It involved uncertainty, with the need to make decisions based on incomplete information, on probabilities rather than certainties. It required discipline, careful attention to detail, adherence to procedures, and it rewarded conservatism, prudence, caution. The actuarial profession in particular embodied these values, with its emphasis on rigor, on mathematical precision, on careful analysis of data, on the building of reserves adequate to meet future obligations. The investment of insurance reserves, the funds that insurance companies held to pay future claims, was a major aspect of the business. Insurance companies were significant institutional investors, holding large portfolios of stocks, bonds, real estate, and other assets. The returns on these investments contributed to the profitability of insurance companies and allowed them to offer coverage at lower premiums than would otherwise be necessary. The management of these investments required expertise in finance, in asset allocation, in balancing risk and return, in managing liquidity to ensure that funds would be available when claims needed to be paid. The insurance industry's relationship with government was multifaceted. Governments regulated insurance, as mentioned earlier, but they also relied on insurance, requiring it for certain activities, using it to manage public risks, partnering with the private insurance industry on programs such as flood insurance, terrorism insurance, agricultural insurance, where the risks were seen as too large or too unpredictable for private insurers to bear alone, or where public policy goals such as encouraging development in flood-prone areas or ensuring food security made government involvement desirable. These public-private partnerships were complex, involving subsidies, guarantees, risk-sharing arrangements, and they raised questions about the appropriate roles of government and of markets in managing risk. Social insurance programs, government-provided insurance for risks such as old age, unemployment, disability, healthcare, were major components of the welfare states that developed in many countries in the 20th century. These programs were funded through taxes or contributions, and they provided benefits based on eligibility criteria rather than on the payment of premiums in the traditional insurance sense. Social insurance was justified on grounds of social solidarity, of ensuring that all citizens had basic protections, of pooling risks across the entire population, and of addressing market failures in the provision of certain types of insurance. The design of social insurance programs, the determination of benefit levels, the financing mechanisms, the balance between universality and targeting. These were subjects of ongoing political debate. The concept of insurability, the criteria that determined whether a risk could be insured, was a subject of theoretical and practical interest. Insurability required that the risk be definable, that the occurrence of the loss be measurable, that the loss be accidental and beyond the control of the insured, that the risk be spread across many similar exposures so that the law of large numbers would apply, that the premium be economically feasible, that the risk not be subject to catastrophic loss where many insureds would suffer losses simultaneously. Risks that failed to meet these criteria, such as risks that were entirely under the control of the insured, or risks where loss was certain rather than uncertain, or risks where the potential losses were so large and so correlated that they could bankrupt insurers. These were generally not insurable through traditional commercial insurance. The limits of insurability were tested and sometimes expanded as the insurance industry developed new products and new methods. Risks that had once been considered uninsurable, such as certain types of environmental liability, certain technological risks, certain political risks, were gradually brought within the scope of insurance, though often with limitations, with high premiums, with careful underwriting, with reinsurance to spread the exposure. The willingness of insurers to innovate, to experiment with new types of coverage, was driven by competition, by the desire to serve clients, by the potential for profit, but it was constrained by the need to maintain solvency, to protect policyholders, to avoid taking on risks that could not be adequately priced or managed. The role of insurance in economic development was recognized by economists and by policymakers. Insurance facilitated trade and investment by reducing uncertainty, by allowing businesses to take calculated risks, by providing protection that made lenders more willing to extend credit. The availability of insurance influenced decisions about where to build factories, about which technologies to adopt, about how to structure supply chains, about whether to enter new markets. Countries with well-developed insurance markets were generally seen as having more stable and more advanced economies, and efforts to promote economic development often included measures to strengthen insurance sectors, to improve regulation, to encourage competition, to increase access to insurance for businesses and individuals. Catastrophic risks, risks involving very large potential losses affecting many people or properties simultaneously, posed particular challenges for insurance. Natural catastrophes such as earthquakes, hurricanes, floods could cause losses in the billions or tens of billions of dollars, overwhelming the capacity of individual insurers and even of reinsurers. The insurance industry developed strategies to manage catastrophic risk, including geographic diversification, where insurers spread their exposures across different regions so that no single event would affect all their policies, risk modeling to better understand and price catastrophic exposure, reinsurance and retrocession, which was reinsurance for reinsurers, and alternative risk transfer mechanisms such as catastrophe bonds. The question of whether certain catastrophic risks should be insurable through private markets or should be managed by governments was debated. Flood insurance in the United States, for example, was provided primarily through a government program, the National Flood Insurance Program, because private insurers were unwilling to offer coverage at rates that were affordable and that reflected the true risk, and because there was a public policy goal of limiting development in flood-prone areas. Terrorism risk insurance, after the attacks of September 11, 2001, was supported by a government backstop in many countries, with governments agreeing to cover losses above a certain threshold, because the scale and unpredictability of terrorism risks made insurers reluctant to provide coverage without such support. Climate change introduced new challenges and uncertainties for the insurance industry. Rising sea levels, changing weather patterns, increased frequency and intensity of storms and wildfires. These trends affected the distribution and severity of risks, made historical data less reliable as a guide to the future, and required insurers to update their models and their assumptions. Some risks became more difficult or more expensive to insure, and some areas became uninsurable through private markets. The insurance industry was also a significant voice in discussions about climate adaptation and mitigation, as insurers had a financial interest in reducing future losses and in encouraging policies that would limit the impacts of climate change. Cyber risk, the risk of losses from cyber attacks, data breaches, system failures, emerged as a major concern in the early 21st century as businesses and individuals became increasingly dependent on digital technologies and as the sophistication and frequency of cyber attacks increased. Cyber insurance was developed to cover losses from these risks, including the costs of responding to breaches, of notifying affected parties, of restoring systems, of defending against lawsuits, of paying ransoms or extortion demands. However, cyber risk was difficult to underwrite, as the risks were evolving rapidly, as there was limited historical data, as losses could be highly correlated across many insureds if a widespread vulnerability or a coordinated attack occurred, and as the legal and regulatory environment was unsettled. Insurers approached cyber insurance cautiously, with relatively low limits, with careful underwriting, with exclusions for certain types of events, and with ongoing efforts to develop better models and better understanding of the risks. The ongoing digitization of the insurance industry, the move toward online sales, toward automated underwriting, toward the use of artificial intelligence and machine learning to assess risk and to process claims, represented the latest phase in the evolution of insurance. These technologies promised greater efficiency, lower costs, faster service, more personalized products, but they also raise questions about data privacy, about algorithmic bias, about transparency, about accountability, about the potential for discrimination, about the displacement of workers. The balance between innovation and regulation, between allowing the benefits of technology to be realized and protecting against potential harms, was an ongoing challenge for insurers, for regulators, for society. The use of telematics in automobile insurance, where devices in vehicles monitored driving behavior and where premiums were adjusted based on how safely the vehicle was driven, was an example of how technology was changing insurance. This allowed for more granular risk assessment, rewarded safe drivers with lower premiums, provided feedback that could improve driving, but it also involved the collection of detailed data about individuals' movements and behaviors, raising privacy concerns. Similar technologies were being explored for other types of insurance, with wearable devices tracking health behaviors, with sensors in homes monitoring for risks such as water leaks or intrusions, with drones inspecting properties, with satellite imagery assessing agricultural risks. The ethical dimensions of insurance, questions about what was fair, about what obligations insurers had to society, about how to balance the interests of different stakeholders, were subjects of discussion and sometimes of controversy. Should insurers be required to offer coverage to all applicants, or should they be allowed to select risks and to decline those they considered too high? Should premiums be based strictly on individual risk assessment, or should there be cross-subsidization, with lower-risk individuals paying more to keep insurance affordable for higher-risk individuals? Should genetic information be used in underwriting life insurance, or should such use be prohibited as discriminatory? Should insurers invest in certain industries or divest from others on ethical grounds? These questions did not have simple answers, and different societies and different insurance markets approach them in different ways. The education and training of insurance professionals, the development of professional qualifications and certifications, the establishment of professional bodies and ethical codes, these were part of the institutionalization of insurance. Actuaries completed extensive examinations and continuing education to maintain their credentials. Underwriters, claims adjusters, brokers, risk managers, all had their own professional development paths, their own bodies of knowledge, their own communities of practice. The professionalization of insurance contributed to the quality and consistency of service, to the credibility of the industry, and to the development and dissemination of best practices. The globalization of insurance, already mentioned, continued to deepen in the late 20th and early 21st centuries. Insurance and reinsurance transactions crossed borders routinely. Insurers operated subsidiaries and branches in multiple countries. Capital flowed internationally. Risks were pooled globally. This globalization brought efficiencies, diversified risks, increased capacity, but it also created challenges for regulation, which remained primarily national or regional. And it raised questions about systemic risk, about the potential for problems in one part of the world to spread rapidly through interconnected markets. The history of insurance, extending now over many centuries, was a history of gradual development, of adaptation to changing circumstances, of the accumulation of knowledge and of institutions, of the refinement of techniques for assessing and managing risk, from the informal risk-sharing among ancient merchants to the sophisticated global insurance and reinsurance markets of the present, from rough estimates and intuitive judgments to detailed actuarial models and data analytics, from handwritten contracts to complex policies governed by extensive legal frameworks. The evolution had been steady, driven by the needs of trade and commerce, by the demands of individuals and organizations seeking protection against loss, by the development of financial markets and of government regulation, by advances in mathematics and statistics and computing, and by the ongoing human desire to reduce uncertainty, to provide for the future, to protect against the misfortunes that were an inevitable part of existence. The story of insurance was not dramatic in the sense of sudden transformations or revolutionary upheavals, but it was consequential. Insurance has become deeply embedded in the functioning of modern economies and modern societies. It is a story of routine, of administrative processes, of the daily work of underwriters and actuaries, and claims adjusters and brokers, of the millions of policies issued and renewed, of the claims filed and assessed and paid, of the accumulation of premiums and the investment of reserves, of the management of risks and the spreading of losses across time and across populations. It is a story that continues as insurance adapts to new risks, to new technologies, to new social expectations, fulfilling its essential function of transferring and pooling risk, of providing financial protection, of enabling activities that would be too risky to undertake without the assurance that losses, should they occur, would be bearable rather than catastrophic. This brings our story to an end. Sleep well.